On a cold morning in lower Manhattan, as soldiers marched off to war, another kind of march took place inside Wall Street's marble halls. Clerks scribbled numbers on ledgers, bankers in dark suits shook hands, and vault doors closed on stacks of money thicker than armor plates. Outside, drums beat for patriotism. Inside, pens scratched for profit. For every bullet fired overseas, someone in New York signed a contract that guaranteed not only survival, but dividends. This was the paradox of American war. Young men bled in trenches, but financiers saw opportunity. For Wall Street, war was not chaos. War was order, a predictable business model, debt issuance, arms contracts, reconstruction loans. Each battle left smoke on the fields of Europe or Asia, but on the stock exchange, it left rising prices and soaring profits. The pattern began as early as the American Civil War. In the 1860s, the Union needed money to fight, and Wall Street stepped forward. Banker Jay Cooke became the government's salesman, organizing the sale of war bonds to ordinary citizens. Posters filled the streets, "Invest in the nation," "Defeat the rebellion," and while farmers and shopkeepers emptied their savings into bonds, Cooke's firm collected millions in commissions. The war that tore the country apart created fortunes in the counting houses. For the financiers, the Union's survival was less a matter of honor than of yield. By the time America entered World War I in 1917, the playbook was established. J.P. Morgan and Company stood at the center, acting as the official purchasing agent for the Allies even before America joined the war. Ships loaded with steel, rifles, uniforms, food, all paid through Morgan's deals. Billions in contracts passed through Wall Street desks, generating commissions at a scale never before imagined. To the public, war was sacrifice. To bankers, it was flow. Money flowing in torrents, redirected from Europe's desperation into American profit. The markets themselves reflected the dual reality. While soldiers drowned in trenches of mud and gas, stock prices rose with each contract signed. Every artillery shell fired in Flanders meant more steel from Pittsburgh, more railcars from Chicago, more financing from New York. For the families of Wall Street, the war was not rationing and scarcity. It was dinners in candlelit mansions, cigars in mahogany libraries, the laughter of children in silk. War, they discovered, could be the most reliable growth industry of all. The interwar years only deepened the pattern. While Europe rebuilt from ruins, American banks offered loans. The Dawes Plan and later the Young Plan restructured German reparations. But behind the humanitarian rhetoric lay opportunity. Wall Street syndicated loans to Germany, earning fees on every issue. The irony was grotesque. The same bankers who financed the Allied war effort now financed the former enemy, ensuring streams of interest regardless of politics. For financiers, sides did not matter. Payment did. Then came 1939. As Nazi armies rolled into Poland, the machinery of finance once again shifted into high gear. Wall Street firms prepared to underwrite massive government bond issues. The U.S. Treasury needed trillions in today's terms, and the banks were ready. Liberty bonds and later war bonds became patriotic instruments, sold in theaters, schools, and factories. Celebrities urged citizens to buy them, to support the troops. But for every bond sold, underwriting fees trickled upward into the pockets of investment houses. Once again, ordinary Americans financed the war, while the middlemen skimmed profits from the flow. The Second World War was also a bonanza for industry, and Wall Street owned industry. Shares in companies like Boeing, Lockheed, General Motors, and DuPont soared as the government ordered tanks, planes, and chemicals by the millions. Behind each contract lay financiers structuring deals, brokering capital, ensuring dividends. The more the factories roared, the higher the stock tickers climbed. While Europe burned, Wall Street prospered. And even as GIs stormed beaches in Normandy, financiers already looked ahead. Reconstruction would be another gold mine. The same pattern repeated: loans for allies, credits for defeated nations, financing for the Marshall Plan. Every stage of war, preparation, fighting, rebuilding, generated contracts. And at every stage, Wall Street's hand was in the ledger. It is tempting to see this as accident, as coincidence. But by the mid-20th century, war finance had become a system. Wall Street and Washington worked in tandem, one supplying weapons and credit, the other supplying political will. The blood of soldiers was measured in basis points, their sacrifice securitized into bonds, their courage monetized into stock gains. And if you followed the story this far, take a moment. If you want to uncover more hidden truths like these, the secret engines behind history's greatest events, make sure to subscribe. That way, you won't miss the next chapter of how power and profit intertwine. By 1945, as victory parades filled the streets, another parade marched quietly down Wall Street. Dividends, commissions, fees, profits. For financiers, the war had been a storm. But storms bring rain, and rain fills reservoirs. They were full to the brim. America had lost lives, but Wall Street had gained wealth. When the guns of World War II fell silent in 1945, Wall Street's role did not end. In fact, it entered a new golden age. The Cold War turned the globe into a chessboard of perpetual conflict and perpetual contracts. Defense budgets ballooned, weapons became more sophisticated, and finance fused with the military in a marriage of convenience. The Soviet Union was the declared enemy, but to Wall Street, the real prize was the steady stream of government spending that poured into defense stocks and bonds. In the 1950s and 60s, firms like Lockheed, Boeing, and General Dynamics became giants, and Wall Street financiers rode their ascent. Mutual funds and investment banks poured capital into these companies, knowing that the Pentagon would be their most loyal customer. War, once episodic, had become institutional. The phrase military-industrial complex, first warned about by President Eisenhower, was not an abstraction. It was visible on trading floors where defense stocks became staples of investment portfolios. The Vietnam War intensified the cycle. Helicopters, napalm, ammunition, uniforms, each order translated into revenue. For soldiers, Vietnam was a jungle of fire and blood. For Wall Street, it was quarterly growth. Yet the profits did not stop with defense companies. Banks lent money to the government through treasury bonds, collecting fees. Insurance firms underwrote war-related risks. Even when the war turned unpopular and protests filled the streets, the ticker tape of profit marched on. By the time the last helicopters lifted from Saigon, Wall Street had already recalibrated, ready for the next theater of conflict. The late 20th century brought new forms of profit. The arms race against the Soviets demanded missiles, satellites, and high-tech research. Wall Street financed research labs, structured defense bonds, and managed pension funds heavily invested in defense stocks. Conflict was not just fought abroad, it was embedded in the DNA of American finance. Every new Pentagon contract was mirrored by a line of profit on Wall Street. Then came the Gulf War in 1991. Operation Desert Storm lasted only weeks, but the financial reverberations were immense. Defense contractors' stocks surged as precision-guided missiles, stealth bombers, and tanks proved their worth. Television broadcast the spectacle live, but behind the screen, analysts noted the profit margins. Wall Street had learned to treat war as not just tragedy, but advertisement, a showcase for military hardware that boosted valuations and ensured future contracts. But nothing compared to the wars of the 21st century. After September 11th, 2001, the War on Terror became the defining business of a generation. Trillions of dollars flowed into Iraq and Afghanistan, not only for weapons, but for reconstruction, logistics, security, and surveillance. Wall Street's reach extended beyond defense giants into private contractors like Halliburton, Blackwater, and KBR, whose shares and bonds were managed by financiers in Manhattan. The trick had evolved. War was no longer only about arms. It became about privatization. Everything could be outsourced. Food for troops, fuel for convoys, guards for embassies, even intelligence analysis. And every outsourced contract was financed, securitized, or managed by Wall Street institutions. While soldiers patrolled deserts, bankers structured deals in skyscrapers, earning fees that multiplied far from the battlefield. The irony was brutal. As veterans returned with broken bodies and minds, Defense and finance stocks soared to record highs. The S&P Defense Index tripled during the Iraq War. Financial firms collected fees for issuing war bonds, underwriting defense mergers, and managing massive flows of Pentagon spending. For Wall Street, war was no longer episodic. It had become permanent infrastructure, like electricity or water, a reliable flow of capital. Even crises that followed the wars carried profit. As oil markets convulsed, traders speculated. As countries borrowed to fund campaigns, banks earned interest. Every disruption was monetized. From September 11th to the surge in Afghanistan, from the invasion of Iraq to drone warfare, every bullet, bomb, and satellite carried with it not just destruction, but dividends. By the 2010s, the scale was undeniable. The U.S. had spent over $6 trillion on post-9/11 wars. Veterans lined up in crowded hospitals. Cities debated budget cuts. Infrastructure crumbled. Yet on Wall Street, bonuses soared. The cycle was complete. Public debt became private profit. Taxpayer sacrifice became shareholder gain. And the pattern has never truly ended. Today, as new conflicts erupt and tensions rise with China and Russia, Wall Street remains positioned. Each new aircraft carrier, each cybersecurity contract, each missile defense system passes through financial pipelines. War, in every form, remains America's most reliable export. The legacy is clear. For every American war, Wall Street has found a way not just to survive, but to thrive. Bonds in the Civil War, Morgan's contracts in World War I, war bonds and defense stocks in World War II, Cold War arms races, Vietnam's quagmire, the Gulf Showcase, the trillion-dollar deserts of the Middle East. All of them tell the same story. The battlefield is where lives are lost. Wall Street is where wars are won. And perhaps that is the harshest truth. War in America is not only a political decision, it is a financial opportunity. For every mother who weeps over a folded flag, a banker smiles over a rising index. For every soldier who limps home, a shareholder applauds a dividend. Blood is the currency of war, and Wall Street has always known how to exchange it for gold.